Be a long one.
All right, this is Mike Doyle and Tom Bennick with the mortgage firm. It is Wednesday at noon, so that means it's Facebook Book Live. And it's just a open forum. Bring all your mortgage related questions. We're just here to kind of have an informal conversation, and we always do cover a topic. Today's topic is going to be, how do I get started? Does it make sense? For somebody who wants to buy a house, and obviously we're big proponents of buying a house, but where do you even get started? And we're going to cover a little bit of that today.
This is definitely going to be the way I like things explained to me, which is it's my first day at McDonald's and you just put me in front of the fry machine. What do I do first? So yeah, this will be certainly a 101, a basic thing to get started. We really want you to kind of get the ball rolling. Of course, we're in June already. The year's going by pretty quick. There's new loan programs that are coming out at the beginning of July. Funding for the Heroes program you've heard us talk about now for the past or since June 1, that funding dried up. All that money has been used, which we'll get into. There's new money coming out, and we just want you to be prepared.
Yeah, the thing, when I say obviously we're a proponent of buying. We're in the business of buying, but everybody has to look at their risk assessment and risk appetite. And I have 4 kids right now. 2 of them have houses. One just bought one. 2 of them are looking. 2 of them are in large cities where the numbers just still don't seem to make sense. So you've got to look and figure out what makes sense for you and your situation. And we'll talk about different situations where we think, yes, maybe it makes sense, maybe it doesn't. But regardless, I tell people is we're on your time schedule. I've got a loan. We got the contract on last Wednesday. We're closing it this Friday. So if you want to close next week, I could probably still close you next week, give me a contract today. But if it's next week, next month, next year, that's your call. So you go ahead and decide what's best for you, but reach out to us and let's figure out where you are in that plan and where you need to be. So when you get to a point where you say, hey, I want to buy, you're ready to pull the trigger. So.
And if you reached out, if we've talked before, then you really want to keep your information updated. I had a customer reach out to me yesterday that I haven't spoken to her. She kind of backed off looking for the past 8-9 months. Said she had some things to take care of. Touch bases yesterday. Just try to update her information on what's going on now on rates. See if anything changed to the credit. So even if it's been a minute or 2 since you've looked, reach out and let's update your pre-approval letter.
All right. We're going to start. And I say this is just the very basics of what we do. And when you're saying, well, what are they going to want? Everybody says, oh my gosh, what are they going to ask for? What are they looking for? And there's 2 things. What I say is, if it were up to me, we would collect nothing. We just give you some money because it's not my money. But the money's coming at good interest rates over 30 years.
There was a time. There was a time.
Right. We get your name and we back a truckload of money up to your house and drop it off. And don't ask a whole lot of questions. That didn't work so well for us. But right now it's basically Fannie and Freddie they lend the money and they have guidelines and they want to make sure that you're going to have a good chance you're going to repay the loan. So we have to go ahead and satisfy their guidelines. FHA goes ahead and insures. That allows you to have a little bit more risk. VA will do the same thing. They'll insure a little bit more. But for the most part, we're underwriting to Fannie and Freddie guidelines, which are fairly close with a few little twists. So what we ask for is a simple acronym ICE. ICE tells the whole story. ICE. We want to know your income. We want to know your credit. And we want to know equity. Equity is your down payment. Do you have some money for closing costs, prepaids, and escrows? So that's basically our whole profession in a nutshell.
Just like everybody's profession, everybody's got the rules, regulations, whatever it is that you've got to, abide by to make your job work. And we have to do the same thing. So these are guidelines that are set by us to be sure you close in a timely manner. So certainly we're going to start with income, and we'll get into the different types of income. W-2 is certainly what's considered a wage earner, somebody that is employed by a company or an individual, whatever it is, and receives a regular paycheck. W-2 at the end of the year, your taxes are taken out, your FICA and all your other items are taken out, and that's just considered a W-2 wage earner. Then we get into a self-employed person. Of course, self-employed person, typically you're going to need to be self-employed for at least 2 years. But again, self-employed people, their taxes are going to be a little bit different. They do have some advantages of being self-employed that maybe the W-2 employee doesn't have. That's why when we have self-employed borrowers, we need to dig a little bit deeper with the documentation. Maybe with the W-2 wage earner, we just might need a couple of recent paycheck stubs and a W-2 for the last 2 years. Well, with a self-employed individual, we're most likely going to need 2 years tax returns personal and 2 years business tax returns. So self-employed people require a little bit more documentation. Retired, typically, if you're retired, you might be getting a fixed income, whether it be Social Security, a disability. It could be you're getting a pension. You could be getting funds maybe that you're withdrawing from your own asset accounts. So there's several different ways that we could work out income for a retired individual. And of course, disabled is any kind of disability, again, income that you might be receiving on a regular basis. So those are typically the 4 types of income that most borrowers generate their income from, one of these 4 categories.
When you have, as Thomas said, that's straight W-2, your 40 hours a week salary. We love that stuff. You're $20 an hour, 40 hours a week. You've been doing that for a while. We love that. And we just don't see that a whole lot. So we start looking at bonus, commission, tips, overtime, a second job. When you start having stuff like that, we need to see, we're looking for 2 years. Do you have a history of overtime, a history of bonus, a history of commissions? Where we are this year, are you seeing those bonus and overtime and commissions this year? Does it look like they're going to continue? So basically what we're looking at is we want to see what your past income is, your present income, and does it look like your income is going to continue? I've had people before, they're like, I made $150,000 last year. So, they want to go ahead and qualify for $150,000 a year. So we start collecting the documents and I get one W-2 for $50,000. Like, well, I don't have those other 2 jobs. Well, if you have the one job that's paying you $50,000 a year and you quit the other 2 jobs, we can't count it. Also, stuff like capital gains. Well, I sold a house and I ended up making $100,000. So, I have $100,000 there. Well, that's great. If you have 10 other houses and you've been selling a house every year and it looks like you're going to be continue selling a house every year for the next, 3, 4, 5 years, we'll count that. But we rarely see something like that on capital gains.
Yeah, it's almost like also getting a part-time job, but just before you make applications. So the rule of thumb, just to keep it simple, is to what have you done over the previous 2 years, and is it most likely going to continue for at least the minimum of the next 3 years? So that's kind of how it's looked at.
If we've had people with 2 full-time jobs. There's so many you're workers.
Yeah.
So if you've had 2 full-time jobs for 2 years, we'll count both those jobs as income. Sure. So it's pretty good as far as that. And we keep saying 2 years, but if you just graduated from school, and you're studying finance, you got a job in finance, you studied nursing, you got a job in nursing, we'll lend you the money right away. So we'll count your schooling as part of your, we like 2-year work history, but for the most part, that 2-year work history can be your job at McDonald's in high school, or it can be your work, your college, your trade school, something like that.
Yeah, there's definitely exceptions. I had a W-2, a veterinarian who was a W-2, worked for an office or a hospital, a vet hospital, but then she went out on her own and all of a sudden became a self-employed individual. But I didn't need 2 or 3 years of tax returns, and because she was going into the same line of work and had a history. So there are exceptions on an occasion.
All right, the big one is credit, and credit is the one, and I hear this all the time. Oh, Mike, I've been working on my credit for the last year, and that's why I didn't call you. And look, call us, because I see it all the time. I closed out these credit cards. I paid off these collections. The collections hadn't been reporting. Collection hadn't reported for a year, so you just paid it off. You negotiated. You started a payment plan. Now you have a new credit. Now you have a new collection. So now your old collections are recent collections. That old credit card that you didn't like, because it's back from your college days and it brought back bad memories, you close it out. Now you don't have old credit. Now all your credits that you opened in the last year or the last month or 2 months. So the old credit is good. Get that old credit card in good shape, get it paid down, and then close on your house, and then you can cancel it and close it out. But let us talk to you. I tell you what, your credit is not the worst credit we'll probably have seen that day. I guarantee it's not the worst that you've seen, that we've ever seen. And the credit just doesn't define you. I say that I can tell when the interesting times of your life were. I can look, see, and say everything paid on time, and then we come to the year 2019, everything's late and charged off. I know that's the chapter of your autobiography that is going to sell the books. That's what I want to read, because that's where the stuff happened. So the credit doesn't define you. Let us take a look at it. Let us run the analyzers on it, and let's see what we need to do to get you in the right place. And I guarantee, after we talk to you and we sort of put you on that path, everybody feels better.
Yeah, and what I want to also touch on is a couple of things. Again, I've had, certainly customers reach out that maybe have stopped looking. You never know what's going to pop on there, between the time that we last looked to today. And again, sometimes something might come on there that might affect your score, even though it was one number, 6-8 months ago, a year ago. Certainly we want to look and see what it is today. The other I wanted to point it out is we do have the ability to do what's called a pre-approval or pre-qual or soft credit report. So we can pull your credit without we can get your score, know what the trade lines look like without putting that inquiry on your credit report or affecting the scores whatsoever. So that's important.
We got a question from Carolina. Will a credit inquiry hurt my credit? I'll let Tom answer that one for you.
Well, that was a great question, because I just kind of went over it. No, it won't affect your credit score if we do the pre-approved credit report or the soft pull. No. When we pull a regular credit report, then of course your score might be affected. I think the average is 7-10 points, maybe something along those lines.
I think it was that much. It's a mortgage credit pull. It's kind of debatable. It's not much of a hit.
It's not nowhere near as what people think it is. So but anyways, no, on the soft credit report, there is no effect to your credit score. And even on the regular credit pull, there's no more than typically, I think, a 5 to 7 hits, depending on, the score itself. So depending on the situation, no.
Yeah. Now we got another question. Do we only do soft credit pulls? Our goal up front is to only do soft credit pulls. But soft credit pulls limit us to only run your approvals under Freddie. So Freddie Mac has certain requirements, and it's great. A lot of their guidelines are more favorable than Fannie's, but Fannie's guidelines are more favorable in certain situations. So if we run it into somebody and we cannot get the approvals with Freddie, then we'll have to go ahead and we'll have to do a hard credit pull so we can run the approvals with Fannie. Now, when we get a contract in, we always have to pull a hard credit pull to go ahead and get your loan approved. And also when we do rescores, so if we take a look at your credit and we're looking at a soft credit pull, we run our analyzers, and we're like, all right, we're going to have to go ahead and pay this credit card down, pay this, open this. And then we go ahead and we get those things done, and then we have to rescore you. We have to go ahead and do a hard credit pull for a rescore. But yeah, our intent up front is soft credit pulls is for two things. It doesn't affect your credit, and it doesn't generate all the spam. So the hard credit pulls, the information is sold like crazy. So when I do a hard credit pull, you might get 20, 30 calls, texts, emails, everything after a hard credit pull. So what we do like to do is we have some opt-outs that I have it written in my notes. I just share it with my customers. So when I do a soft credit pull, I send it to them and I say, hey, opt out right now. And then by the time you put your contract in, everything should be in, and we should be able to reduce some of those spams. But if you're online and you are looking for properties, they're getting your information and you're already starting to get contacted for stuff. So get into those opt-outs as early as you can.
The other advantages of a soft credit pull is if you're concerned about what your credit score is, we can look at the credit score as it currently is and then look to see what improvements we need to make without affecting your credit score. There are several advantages to the soft credit pull. So please reach out to us. We'll take care of that.
And another very important advantage, which I know Tom and Elizabeth have very little concern about, is they cost me a little bit less on a soft credit pull. But
Notice Mike had to use the word me because it does affect his pockets, not necessarily ours. But
it is nice. I tell you, customers love it. I love to be able to say to them, let's do a soft credit pull.
Yes.
Because I know the customers really do prefer that soft credit pull. And you know what? It's very, I would say 90% of the time, we're able to get what we want, get the pre-approvals we need done without having to go to that hard credit pull. So yeah, very happy with that.
But we cannot, last but not least, we cannot provide a pre-approval letter based on a soft credit pull. I believe it's got to be.
I don't think we provide a loan commitment, but I'm pounding.
There we go.
All right. So now, also building credit. We'll do a little bit as far as We'll pop through there. All right. Credit score, not to go too much on it, but payment history. The payment history is a tough one. I can't do a quick fix. If you're paying everything late, I can't quick fix that. You got to get everything set up. I just set it up on auto pay. So, I mean, if you're not comfortable in auto pay, you're not comfortable, but I'd want to set it up on auto pay. Just at least have your minimum payment go out, so you're never late. Now, on your credit cards, get used to just getting in and paying them down. So just go online. I don't care if it's every week. Keep your credit cards at least under 50% balance. So if you can keep them under a third balance, that's even better. But one of the problems people do is like, oh, I pay my credit cards off every month. I pay them off. Well, if you've got $1,000 limit and you run it up to $990 and then you pay it off, if they report the day before, so every month they're reporting that credit card is maxed out. Well, somebody else who has the identical payment profile as you, but their credit card reports that the day after they pay it off, they're going to show that their credit balances are very low. So the two of you are going to have the same lifestyle. The one person just pays off the day before the credit reports. You pay it off the day before it reports. They pay it off the day after it reports that zero. They're going to have 100 points better of credit than you. So instead of trying to track when everybody reports to the credit bureaus, just make sure you keep all of your balance low at all times. And I wouldn't pay everything off to zero. I'd have a little balance. And if you've got a credit card like, oh, I just never use that credit card, it's not helping you a whole lot. If you got a credit card that's had a zero balance on it for 5 years. And I will say the one thing, and Victoria's Secrets is notorious for this. People never use the card. They don't use the card, but then they get hit and they might get a first year free, without an annual fee. And then the annual fee pops up, and then they end up with a late payment on a credit card for $25. And they haven't used that credit card for a year and a half, whatever. And they end up with a late payment on that credit card. So be careful when you're opening up a credit card because you're getting 10% off your purchase, because that credit card could be the one that comes back and costs you.
Yeah, credit cards are certainly, we all get them in the mail, and they offer an awful lot of nice benefits, but it's the small print that we try to read.
Yeah. So the payment history, do you pay on time? That's 35% of your score. Amounts owed, the percentage of your high credit. So if you got $1,000 high limit and you owe $990 or $1,010, you're maxed out. That's 30% of your score, which is a huge hit. If you just opened all of your credit cards last month, that's 15%. So you want that old credit, and then your credit use, how do you use them? How much do you use them? And new credit. If you're out there opening up all these new credit cards, that's going to hurt you. So when we tell people to build credit, sometimes we'll have them open a credit card or installment loan or something like that. You might take a little bit of a negative hit early, but the idea is that we're trying to get you to get some positive trade lines offsetting some of your negatives.
And please don't go in and start disputing a lot of accounts that you don't agree with. That could do certainly more harm than good. Disputing accounts only takes that account out of the logarithm, they call it, that determines what your score is. And once we are ready to make offers or pull the trigger, we are not able to have any accounts that are in dispute. So please don't call and start putting accounts in dispute. It does not benefit your score whatsoever. Most likely it does more harm than good.
Yeah, if you're, like Tom said, essentially, if you come in, because people start disputing right before they start looking at their pre-approval. Now, if you just sign your lease and I'm like, I'm doing this for another year, so I got another year of this. And if your credit's a mess, it's not a bad thing. Go ahead and dispute everything. Go ahead and dispute the accounts that you want to dispute and force them to prove that, yes, this is legitimate. Because a lot of times you look at your credit report and you're like, I don't know where this came from. Or you have a lot of late fees and things like that. So you throw the disputes and you give everybody a chance to go ahead and address them. And then they come back and they're like, oh, yeah, this is legitimate. And then maybe you get one or two or something to drop off. But we're going to have you remove them anyways, like Tom said, before we can actually get anything done. So you might have an artificially high credit score because they're not reading the disputes right. And then once we get them all removed, your score drops, then we're in trouble. So be very careful with those. All right. Equity. Equity is your money for your down payment. How do we track your money? This is probably, I'd say, Tom, this is where we can frustrate the customers the most. As that money's moving around and we're tracking it down, always frustrating. So
Yeah, this is certainly why we try to ask, of course, a lot of questions as far as where the funds might be coming from for the down payment, for the closing fees. Look, there's a lot of options, whether it be down payment assistance programs. We have gift letters that maybe you can get from family members, bank investments. There's all kinds of ways. We just want to be able to structure it properly. So if you're going to be using maybe gift funds, that's great. We just need to know who the donor is going to be and get the necessary paperwork. If you've got a family member that's willing to help purchase with some gift funds, bank investments or first-time buyer programs, of course, those have the down payment assistance programs. So yes, there's all kinds of ways now that we can help, or there are out there to help get in the front door. We just need to have the correct way to verify those funds.
Yeah, if you've got money in a safety deposit box, you need to get that in your account early, because that's the stuff that'll kill a loan. So when we got cash deposits, it's a problem. So we need to go back 60 days. And I know people are asking why, because we got to source the funds. I mean, the real estate was a big source for money laundering and just people hiding money or using money, bad money in real estate transactions. So they really want to make sure that the money that's coming in is good money. Also, we're looking to make sure it's not borrowed money. So we see a big deposit in your account. We're trying to make sure it's not some high interest loan that you took that's going to make it difficult for you to repay the house. So if you sell something, that's fine. If you got a boat or a trailer or some type of vehicle or something legitimately that we can see that maybe was registered, we have an invoice, we have, we can show that it was sold and we can see it being deposited in your account, we can go ahead and use that. A lot of times there's things of value. People might have stamps or money or comic books or things like that, and we can go ahead and show it. Then we can use it. Retirement funds, absolutely. Retirement funds, always check with your fund manager. A lot of times you can pull money out of your retirement funds and not pay a penalty on it. You're going to pay taxes on it as income, but you're not going to pay a penalty. So, we can get funds from multiple sources. Gift funds, we do have to take a look because it has to be an acceptable donor. And depending on whether you're doing Fannie or Freddie, FHA or VA, it's different acceptable donors that we have to be looking out for. So that can always be a little bit tough. But also, when we look at your bank account, we see a $50,000 deposit. All right, it came from this account. That's fine. Give me a copy of that bank statement. All right, that came from that account. And it can start getting deep. We're chasing accounts after accounts after accounts. Oh, this came from, my wife. All right, she's not on it, so now it's gift funds. So, in general, on a conventional loan, we don't have to look back at gift funds. But if it's an FHA loan, now we have to start sourcing the money out of her account. And then as you're having family members sourcing accounts for us, those can be a little bit tricky. Right.
Yeah, just to get on top of that, depending on the loan program, it's going to depend on how we have to verify the gift funds. And we're only asking so we know how to provide that verification with the path of least resistance. As Mike pointed out, if those funds are going from 4 or 5 different bank accounts, we've got to verify all that. But if it goes from point A to point B, well, that's one simple verification. So, yeah, it's just a certain way it's got to be done to follow the guidelines.
Mm-hmm. All right. And just real quick, we're going to go too heavy, but just the process. The process is pre-approval. So you reach out to us, we'll get some information, we'll do the soft credit pull, we'll take a look at your documents, we'll figure out how Fannie, Freddie, FHA, VA, USDA, how they're going to count your income. And again, they all may count it a little bit differently. So we'll determine which loan program is the best fit, how your income is going to be counted, and what you're going to be able to qualify for. So then you go out there, you make an offer on a place, we'll call the listing agent, let them know that you've been pre-approved. They'll know our company, know that our pre-approvals are good, and they'll go ahead, they'll accept your contract, hopefully, and then we'll put the address in it, we create an application. So the application is created, we send you the information, you review it, you sign the documents, you get it back to us, it goes into setup. Setup orders appraisal, title, verification of employment, bunch of background stuff, and then the setup department turns it back to the processor, and the processor scrubs it and does all the behind the scenes type work, sets it up, prepares it for the underwriter. They'll reach back out to you and say, hey, we need to get a couple updated items. And then the processor turns it over to the underwriter. Now, the underwriter is the one that everybody blames for everything. Oh, it's an underwriting. Every problem's blamed on the underwriter. We have amazing underwriters, absolutely amazing underwriters. And our underwriters are trying to close loans. So we want to make sure that our stuff is set up and that it's compliant. And Fannie and Freddie are going to look at it and love it. And the investors all are going to be happy with the loans that we give them. So the underwriter just wants to make sure everything is set up right. And I tell people, people look at it a lot of times personally, and they'll get upset, when we're asking for some stuff occasionally. But what I always want to do is I want to protect the underwriter. These loans, I don't care your best intentions. We've all been there. We're rocking along. Everything's doing great in life. And then you just get kicked in the teeth and you got some problems. So when these loans go bad, and they do every blue moon, they get pulled out and the underwriter's called out. So we want to make sure that we've laid everything out for the underwriter to say that we've built the best case, showing that this customer, has done everything and that they're a good investment. So the underwriters get back, they give us the approval, conditional approval, comes back, processor gets the additional information, make sure the title's done, survey's done, appraisal's done, insurance is ordered, and then we submit it back for a final approval. And then we get the final approval, it goes to closing, and then we schedule the closing. So that's, in a nutshell, our process.
And I'm going to just touch on number 5 for just a second on the underwriter part. And just to give a little bit of a behind the curtains, what happens with loans after the borrower closes, gets the keys, and now you own the property. Well, that loan now for the mortgage firm now is going to be sold or presented to Fannie Mae and Freddie Mac. So we loaned you, or the mortgage firm loaned the $500,000. Of course, we want to loan that $500,000 back out again. We're going to sell that loan to Fannie Mae and Freddie Mac under the guidelines that they provided that our underwriters need to abide by. So for us able to sell that loan to Fannie Mae and Freddie Mac, we get $500 back, or the mortgage firm does, and we loan out again. It's a cycle. So the underwriter is only giving us the items that she needs to ensure we can sell the loan, or the mortgage firm can sell the loan to the secondary market and continually do business the way we're doing business.
And we maintain the servicing for a good chunk of our loans too. So right. we may sell the stuff out, or we may keep the servicing. There's a couple different things, but we have to make sure though, that everything is underwritten to Fannie and Freddie guidelines, because we don't want to make it Mike Doyle's loan for the next 30 years. So.
Right, and that's what would happen if it ends up where it can't be sold. Then the actual office needs to hold that loan for the next 30 years, and nobody would like to do that. So that's where we get the underwriting from.
Right. All right. We're going to do I like to throw in this stop thing here too. These things seem obvious. People are like, of course, like they roll their eyes when we say it at them, and you can't believe how many times we'll see it. I had a realtor's at a walkthrough, and she says, "Hey, your customer's driving a brand new car." I'm like, I didn't know that. So I called the customer, and they're, "Oh yeah, well I traded my other car in." So now, and then when we do the refresh, the day before closing, it's going to see a credit inquiry. So then we have to go ahead and make sure that the new payment doesn't blow the loan up. We've had people that are like, finally, hey, I got my clear to close. Oh, I hate this stinking job. Now I can quit. No, we're verifying your employment. You need to have your job. So you need to keep your job, and it's fine. I mean, if you have to quit a job and start a new job, and it's a better job, and it's all good, and you're still salary and the money's absolutely, we can count all that, but we need to know that beforehand. Don't buy furniture. Don't worry, Mike, I don't have to pay for a year. That's a problem. All right, because we still have to count the payments against. Moving money around can also be a potential problem. Just kind of go about your regular work. What else have you run into, Tom?
Well, I wanted to point out that, as you can see, by the way, I can only speak for myself with the gray hair in here. And after doing this industry for over 20 years, Mike and I, what do they say, 10,000 hours makes you somewhat of a professional, for the lack of a better word. These are the things we want to point out to you, the things not to do. Regretfully, I've had, maybe loans delayed because somebody purchased rooms to go furniture, no payments until the year, 2075. Well, still got to count those in your debt. So we're just bringing these items to your attention to please notify us and let us know before you make any major decisions, between the time you make application to closing. That's all. The industry isn't prejudiced. Mike and I are both in it for 20 years or more. There's no issue turning somebody down. I've seen people get turned down with millions of dollars just because of a certain statement or something on their bank statement. So that's why we want to look at everything and ask you for as much documentation as we do.
All right, let's touch base real quick on, because we just are going through classes. Hometown Heroes it's a good program. It's down payment assistance. And it started last July, and they funded it with $100 million, and it was to help policemen and firemen and educators and nurses and people in the medical industry, and they really expanded. It was, chiropractors, anesthesiologists, anesthetists, just medical technicians. So it really was very far reaching. Well, that money ran out in 11 months. So they refunded it for another $100 million starting July 1st, and they've opened it up to all first-time homebuyers. Now, first-time homebuyers means you have not owned and lived in a primary residence in the last 3 years. So you might have bought a primary residence 5 years ago, you lived in it 2 years, you moved down, whatever, to Florida, and now you've been renting for the last 3 years. So you're still considered a first-time homebuyer. But you qualify for all first-time home buyers and all veterans. Veterans, they all qualify for this. You qualify for this new program. And Tom, I think you went to the class. What are some of the expanded parameters on this new one?
Well, this is now it's actually going to be available. I think the first is going to be on a Saturday or Sunday. July 1st is the actual date. It's $100 million. Excuse me for reading my notes here. So you must work. Some of the important factors are you must work for a company, of course, in Florida. It must be a Florida-based company. You've got to do at least a minimum of 35 hours per week. There are no occupational requirements. So one of the things that we have to look for now is if your occupation is on the occupational list. In this case, there are no occupational requirements. The amount now that can be applied towards your closing instead of $25,000 is going to be raised to up to $35,000 and a minimum of $10,000. So for those of you that might have smaller loan amounts, you can still get a minimum, I believe, of $10,000 as that second loan to cover your down payment and closing fees. And as these guidelines come out, then we'll continuously update you on them. But that's what was discussed as of now, basically.
Hey, we got a question from Ken. Can you have a co-borrower? Can you have a co-borrower on this loan?
Yes, you may have a co-borrower on the loan. We'd have to look out to see if that co-borrower has owned a property in the past or also over the last 3 years. So, again, this applies to FHA, VA, conventional. So we're going to just find out exactly what program will work for you. But yes, you can have a co-borrower, certainly.
Yeah, you can do. If you have a co-borrower, just as Tom had said, if there's a co-borrower and something they're going to be living with you, they have to be a first-time home buyer. Now, if they're a non-occupant co-borrower, they don't have to be a first-time home buyer. But on the Hometown Heroes program, we are going to count their income. Now, Hometown Heroes for Palm Beach County has been expanded to 146, I think, of income, maybe 148. I think it's 146. But the two incomes combined can't be over that amount for the Hometown Heroes. So we're going to add up all the borrower's income, the qualifying income, and make sure it's under that exact amount. And I will say, though, for bond, because they've opened bond up a little bit too. On bond, if you have a non-occupant co-borrower at this time, you don't have to count the non-occupant co-borrower's income. You have to count everybody's income within the household, though. So with Hometown Heroes, we just count the qualifying income. If you make $140,000 of salary and you make $1 million of bonuses, if you're qualifying on $140,000 of salary, we're going to just count the $140,000 you qualify for Hometown Heroes. Mm-hmm. So they each have some things that are good. Now, the one thing I really like about Hometown Heroes is the pricing is good. And again, this comes back to Tom and Elizabeth not caring a whole lot because they cut the margins on the branches. But, we're happy to do them. It helps people get in there. The rates are great. The costs are good. The closing fees are lower. You have some taxes, governmental fees that are lower. So it's a really good loan. Now, the biggest thing for people to know is the money does have to be paid back. So if you get a $400,000 loan, you get $20,000 as a second mortgage to help with down payment, closing costs, prepaids. You don't have any payments. You don't have any interest on it, but you do have to pay it back when you refinance, sell the house, or pay the property off. So it is something that any financial planner will say if someone's going to give you $20,000 now, not charge you, and they want $20,000 back in a couple of years, to take it. But it's almost easier said than done because, my concern is when it comes time to refinance, if the rates drop considerably in the next couple of years, which we're hoping they will, if you don't have that $20,000 to get back and you don't have the appreciation to pay it off, then you're not going to be able to refinance according to the guidelines as they are right now.
Well, it's going on 34. We've extended by a little over 4 minutes. We want to remind you to please go to our Facebook page. Please like and share our comments. We've got a class going on this afternoon at 6:30. Bring your questions. It's also on first-time buyers, other programs that we're offering. But please go to our Facebook page. Please share it and comments. Send us any information or any questions you might have.
TMFclasses.com. Register for, we have multiple classes coming up, TMFclasses.com, and that's our Zoom class at 6:30 tonight. And yeah, the mortgage firm Wellington Lake Worth is our Facebook page. So the mortgage firm Wellington Lake Worth, go on there and follow us, and then you can take a look and see all of our good stuff. Hopefully we'll see you at some more of our events. Have a great day.
All right, thanks. Bye.